Hey everyone, welcome to the Lazy Paddler Investor Show. Oh, and I've got a controversial topic for today, and I've got a spreadsheet to prove it because spreadsheets are fun, right? Inflation is a wealth tax. Let me say this claim one more time. The United States and most other governments, any government that has a fractional reserve banking system, causes inflation on purpose. That inflation is a tax because to you and me, normal people, a tax is when the government takes your money or your buying power away. In this situation, in inflation, they're not actually saying, hey, give us money. No, they're not doing that. That would be more direct. And it is more annoying, right? Because you got to fill out forms and do all kinds of stupid things. You got to send a check. No, inflation is very convenient. It is very easy. It is almost invisible. Most people do not even know it is happening. And let me say that one more time. Most people, more than 50% of people, do not understand what inflation is, how it works, why we have it, and they sure as heck don't understand that it is happening to them every year. They see things like, oh, a Big Mac cost 25 cents in 1952, and they're like, oh, well, that's weird, and they don't think about it any more than that. The U.S. Federal Reserve targets a 2 to 3% annual inflation rate for U.S. currency. And you can argue about whether this is good, whether this is bad. It is what it is. This inflation rate is managed by bureaucrats at the Federal Reserve who may or may not have our best interests at heart. There are lots of reasons they believe it is a good thing to inflate the currency every year. It kind of encourages reinvesting your money back into the economy, like buying shares of stock, maybe reinvesting in your business, buying new equipment, buying land, that sort of thing, instead of hoarding your money. It encourages money flow, right? And by encouraging money flow, by encouraging people to lend and borrow and use the banking system, this increases the monetary supply. But this is, I think, their reason behind it. It's not necessarily nefarious, right? And 2 to 3% every year is manageable for most people. But here's the thing about that 3% inflation, right? And I'm going to use the term inflation when I'm talking about this, but understand my argument here is that inflation is actually a tax on not just you, everybody who owns anything denominated in American dollars or the dollars of or any other currency, not dollars, but any other currency, right? The euro does the same thing, the Chinese do the same thing with their yuan, the Japanese do the same thing with their yen. I could go on. Everybody inflates their currency on purpose. When they generate additional money through the Federal Reserve, this is reducing the value of everything denominated in, we're going to focus on US dollars right now. Everything in a savings account, all contract values. If I say I'm going to buy this house for $1 million, that contract value becomes less and less valuable over time. Loan repayments. So if you have a 30-year loan, the dollar you pay today is going to be worth more than the dollar you pay in 30 years on that loan. Your bond returns, your investing returns, everything denominated in those dollars. The value of my iPhone, the value of my car, everything. Now, notably, this also changes everything we owe, right? So I included my loan repayments in that. This is part of the reason why we have fixed rates on loans or variable rates on loans. The variable rate can change depending on how inflation adjusts. And you'll note that they're often pinned to inflation. Fixed rate loans are almost always at the time of origination, when you originally buy that loan or contract for that loan, they're always going to be higher than those variable rates, those floating rates. Because of this, right? They want to essentially hedge. They are afraid that that inflation rate is going to get higher and they're not going to be able to earn money on that loan. That's why that rate is always higher on fixed rate loans, because they don't change during the term. When you're basically saying, okay, I'm going to give you a loan for 30 years, I'm going to expect you to pay it back at 4% or 5% or 6% or 7%, you need to be able to make money on that as a bank. Otherwise, you're going to go bankrupt, right? And you don't want your bank to collapse. That's bad for everybody. That's bad for the entire economy, right? Big bank collapsing because they can't price loans correctly, right? But they always have to factor in inflation, because that dollar in 20 years or 30 years is just not going to be worth as much. Also, fun, interesting corollary, which is up on the screen right now, a lot of people get 2 to 3% annual raises. When I worked for other people, this is the kind of raise that I got. Almost every year, I would get a 2 to 3% raise. Thank you, sir. May I have another? This is not actually a raise. You are essentially keeping pace with inflation. Let me show you how this works. So right here, what we're looking at is our target inflation rate of 3%. What I've done in this area here is I've said, okay, if this year I have $1 million saved, $1 million in cash, what is that $1 million going to be worth next year? Now, keep in mind, the dollar value of my savings never changes. I just put it in a checking account and I let it sit there with zero interest, nothing. The number in that account's not going to change. It's going to be a million, all the way to 2049 on this chart. From 2026 to 2049, it would say $1 million the entire time. But the relative purchase capability of that $1 million compared to the purchase capability in 2026 goes down by 3% every year. So basically, I'm multiplying each of these by 97%. So just 3% less for each one of these. And it goes down 3%, then 2%, then 1% as you get closer to the bottom, right? Or close to those. So as we go down, 1 year later, I've already lost $30,000. By 2036, I've lost more than a quarter of the value. By 2049, I only have half the purchasing power that I did before. If I just leave that $100 in a basic checking account with no interest, I'm basically getting taxed by that 3% every year. And now my money is only worth half of what it was before. This happens to you regardless of whether you're holding your cash in your basement, in your drug haven in Costa Rica or Venezuela, or whether you've got it in like a sky palace. It doesn't matter where this money is. It doesn't matter if you stole this money or if you got it through ethical means. It doesn't matter if you got your money from the government originally or whether or not you received it as pay for work that you did. It doesn't matter whether you're a famous actor or a movie star or a singer or a homeless person on the street with $10 in their pocket. It doesn't matter if you're a drug dealer, contractor, plumber. Everybody who has savings of any size, billions of dollars, trillions of dollars, tens of dollars, the value of your money is being reduced by about 2 to 3% every year on purpose by the Federal Reserve. This is essentially, from your point of view, a tax. And in order to kind of make you feel this less, employers will often give you a 2 to 3% raise. Because if an employer was to just give you no raise at all, you would be working for less every year. And you would feel it quickly. Because within basically 3 years, you would be essentially earning, about 10% less. You would feel that. Absolutely. You would feel it at the gas pump. You would feel it when you go to buy food. You would feel it when you go to buy a car, when you pay your rent. Like, it's a big deal. 10% is a big deal. You would feel it. So what most employers do is they say, oh, well, my employees are going to get angry and they're probably going to leave if I essentially am giving them a pay cut. And so they say, all right, what was inflation? Let's give them a raise, quote unquote raise. Well, let's make them feel good about this. We'll call it a raise. We'll do this whole song and dance. We'll give them a review of their performance to see if they're doing well. And we'll give them a 2 or 3% raise every year. Let me show you how this works. This is a 3% annual raise. If your annual income this year is $100,000, you get a 3% raise to $103,000 next year. Year after that, $106,090, yada, yada, yada. It goes, and you get $151,000. Your raise has finally pushed you up to $151,000 by 2040. And then by 2049, you've almost doubled your income. You're now making almost $200,000. I also have this other column over here, which is your annual income adjusted for inflation. Check this out. Check this math out. If your targeted inflation rate is 3% and you get a 3% annual raise, little by little, you're still losing money against inflation. The way the math works out, which is funny. So even if I change this to 2% annual raise and you have a target inflation of 3%, look what happens. Your actual annual income adjusted for inflation is no longer $100,000. It's $78,000. And this is why people are kind of waking up right now and they are saying, wow, I feel like I am earning less. I have less buying power, even though I am earning more money than I did 20 years ago. Right? I've been working for, 30 years. I've been salaried or making a kind of full-time employment money for 25 years. This is how it feels to me. I feel like I've been making about the same amount of money the entire time. Now I've managed to do things like pay off my debt and make good financial decisions, good investments and things like that. And so I'm not this, I don't feel this like other people do. But if you live paycheck to paycheck, this is a 22% loss in your pay over, how many years is this? Let's count these years. 24 years. Yeah, this is about as long as I've been working, right? And this is what happened to me. Our target inflation rate was 2 to 3%. Some years it was higher. Some years it was lower. But my annual raise, this was the annual raise that was my target at my old job. And so I was getting paid less and less and less, even though I was getting a quote-unquote raise. So some years I got 2%, some years I got 3%. Over time, it builds up. Now, even if the target inflation rate was 2%, you would still, after this 24-year period, you would still end up with purchasing power that's 63% of what you started with. That $1 million in your bank account is functionally only worth $628,000. That's a huge change. 2% doesn't look like much, does it? It's massive over the long term. Massive. A 2% annual raise can keep you afloat basically. It can keep your buying power adjusted for inflation going. The closer we get to zero, obviously, the closer this all balances out. But if there is a year where the inflation rate is 3% and you get a 2% raise, that additional decrease in your annual income adjusted for inflation will stick with you for the rest of your career at that company. This is why people who stay in job for a long time and they kind of depend on those annual raises, they're basically walking into this problem. They're walking into it. That's why a lot of young people basically switch jobs every 2 to 3 years, because they feel this happening very quickly. And they know if they change jobs, they might be able to get a 5, 10% raise, maybe even more. You can maybe get a new job, but what you can't do is control what happens to your cash. You have to convert your cash into something else in order to beat inflation. Now, some people are like, gold, Bitcoin, buy bonds, buy US Treasuries. All of these things are ways to give you an interest rate repayment that kind of keeps you afloat against this target inflation rate. In my opinion, the best way to hedge against this is to invest in common stocks on the stock market. That's what I do. I can't tell you what to do. I'm not going to give you investing advice. You need to make your own decisions, figure out stuff for yourself. That said, if you're not earning higher percentage on your money most years, or like over the long term, than the aggregate inflation rate, you're walking into this trap. But regardless of whether or not you get more returns or less returns, regardless of whether you invest in gold, again, or Bitcoin, or Ethereum, or Tesla, or Netflix, or Nvidia, or any of a host of other companies out there, regardless of what you invest in, all of those contracts, all of those shares, all of those prices, every price everyone pays for their Netflix subscription, every price you pay for a loaf of bread or an egg at the market or a gallon of gas, all those prices are inflated by this inflation rate. So if you say to me, oh, I did really great in the market last year, I got a 20% return, I will say, fantastic. When you adjust that for inflation, what is it? It's about 17%. You are constantly treading water. You are swimming up a gentle stream, essentially, right? And the investment returns you have are the power in your arms and legs to swim against that gentle stream. This inflation rate is that gentle stream. It's going to pull everybody back at the same time. And so when I say that inflation equals a tax, I mean very specifically that inflation is a tax on wealth. There are a ton of people out there right now proposing wealth taxes. They're saying, oh, we should tax Elon, and we should tax Larry and Sergey, and we should tax all these billionaires. And all the billionaires are saying, whoa, 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 if you start taxing things like unearned income, that's going to cause a lot of problems. And they are right. They are right. That's because the quote-unquote wealth taxes that are being proposed are not actually taxes on wealth. Let me say that one more time. The taxes that are being proposed, the name is a lie. They are not taxes on wealth. We already have a wealth tax. Inflation is the wealth tax. It hits everybody equally at 2 to 3%. People don't get angry about it. Well, I mean, people do get angry about inflation. They definitely do. But it is contained. We deal with it, right? It's understood. It's part of how our system works. Enough people are okay with it that we can move on as a society and not worry about it too much. But make no mistake, it doesn't matter how big I make this number, trillions, quadrillions, a 3% inflation rate hits it all the same. But here's the important difference between the wealth tax on the wealthy and inflation. Here's the big difference. This wealth tax forces the wealthy to sell controlling shares of companies to pay it. It is confiscation of control. The target inflation rate reduces the value. It reduces the value of all the shares. So let's use Elon as an example, right? He says he's a trillionaire. The maths, his controlling interest in SpaceX and through its subsidiaries X and XAI, and his controlling interest of Tesla maths out to make him a trillionaire. Cool. So let's say he has $1 trillion minimum. He doesn't have that in cash, right? He doesn't. Those are the value, the market value of his shares in those companies. If he was to sell one share, he would have some cash, right? And I might buy that share. Shares aren't that expensive, a couple $100 maybe, right? But here's the thing. If he has to pay 2, 3, 4, 5% of his $1 trillion, all of a sudden he has to sell, what, $50 billion worth of stock? $50 billion worth of stock he has to sell. That's a lot. I can't buy that off of him. I don't have $50 billion. Who's going to buy that? And that is why share prices plummet when people are forced to sell. What this also does is it forces him or any other founder to have less control of their company. All of a sudden, maybe they had, let's call it 100 million shares of a company. All of a sudden, 5% of those shares have to be sold. So that 100 million shares might represent, say, 30% of the control of a company. If they have to sell 5% of that, they're now reducing their total control to like 28.5, to do the math quickly in my head. This is confiscation of control, specifically targeted at people who have founded companies and made a ton of money because the value of those shares are now high. And this is specifically called out and made plain in the California proposition from the union SEIU-UHW. The 2026 Billionaire Tax Act has the following phrase in it, and Grok told me this, so I'm hoping this is accurate, but I've seen it a lot of other places, so I believe this is correct. For any interests that confer voting or other direct control rights, the percentage of the business entity owned by the taxpayer shall be presumed to be not less than the taxpayer's percentage of the overall voting or other direct control rights, which is a stupid, convoluted way of saying we're going to treat all your voting control shares as if they're real shares, even if they're not worth that on the market. Even if you have a voting share that's worth 20 to 1, right? We're going to treat that as if it's, and there are some companies organized like this. Google, for example, is organized like this. That way they were able to sell stock that had lower voting rights than the voting rights of the original shareholders. And everybody who bought the shares was well aware of that when that happened. They knew that they had less voting rights, and they're okay with that. What this does is it forces these people who have billions of dollars of control shares to sell them because there is an alternative, right? There's an easy alternative. You want to tax people more? You want a wealth tax that balances out and hits everybody? Increase inflation. Boom, done. But everybody doesn't want that, right? Nobody really wants our inflation rate to be higher. You don't want inflation at 5%. That's scary. Argentina had inflation at like 2 and 300%. It was terrifying for them. They could not save. They had to buy things that would be worth something later on. They couldn't save for retirement. That's terrifying. You don't know where you're going to be in a couple of years when your government treats you like that. So this target inflation rate is really, really important. We already have a tax on wealth. The purpose of these purported wealth tax is not that. The purpose is to strip control from founders of very successful companies. That's it. That's the game. I consider this to be an unconstitutional taking myself. I do not believe that it is an appropriate tax in the United States. There is a reason why we do not have any of these taxes on the books here. They go against everything we stand for as a country. The opportunity to become a business leader, the opportunity to own the thing that you took the risk to create, the thing that you bled for and sweated for all your life. They want to take it away from the people who are the most successful. And you know what will happen after that, right? Other people who see that happening will say, well, I'm not going to do that. If my company gets up close to $1 billion, I'm going to split it. I'm going to split it into subsidiaries. I'm going to sell it off. I'm going to do anything I can not to hit that $1 billion level. I don't want to get anywhere near it. If you get to $500 million in personal assets and your company is doing really, really well, you could easily the next year trigger a wealth tax. Because if your stock all of a sudden pops and doubles the next year because, you have a good press release or something and people are like, oh, yay, this AI stock's going to the moon. And they run up your shares. All of a sudden, you're a billionaire? Is that real? You haven't sold those shares. Functionally, you don't have a way to do so. And once you start selling, the price of your stock is going to plummet because it will look like you are trying to evacuate. You are trying to flee the sinking ship. They won't necessarily know that you're paying a forced wealth tax. They can't know because it's not obvious, right? Like a lot of people who have wealth, you can't see it all. You can try to explain it to people, but the fact is those shares are still going to flood the market. Who's going to buy them? The answer to that question is, unfortunately, these hedge funds, right? Sovereign wealth funds, countries abroad, investors from abroad, investors from, or foreign governments could pick up these shares. We sell them on the open market. Anyone can buy them as long as as long as it's not illegal for them to engage in trade with the United States. So all of a sudden that American wealth goes overseas, control, and it's not just wealth, right? It's control. That control goes overseas. Think about that. Think about what they're trying to do here. This is forced confiscation of control over American companies for wealthy Americans. The people who have done the most to create the most value in our country, that's who they're targeting. What does that do for hope? What does that do for people who want to be successful in our country? This is pretty bad. It would be a disaster for us. It would not be a disaster in the first year. But in the second and third, it would be a disaster. Absolute, phenomenal disaster. There are worse things the government can do to you. This is true. But all of those things would follow along after this got enacted. I'm telling you right now, those bad things would follow on this. Because this kind of confiscation directly leads to the kind of situations that we saw in the Soviet Union. Confiscation of private wealth is acceptable when it's done as inflation, confiscation of the value of your wealth, but confiscation of control, that's a huge problem. That's something entirely different. And these quote unquote wealth taxes, that's exactly what they are. Talk about it below if you're interested. Share this because I'll make more of them if people want to hear more about this issue and other important issues facing our economy. So yeah, this is just me. I'm not an economist. I'm just an investor. I'm just a guy. I worked at a bank, but I didn't really do banky things. I was more of an analyst, so like a computer analyst. So like this is my spin on it. I could be wrong. Let me know. Peace, everybody.